Breaking, a hardware-led surge is decoupling tech leaders from a neutral market as compute demand ignores policy risk. Tesla is up over 3%, fueled by its massive data moat and Cybertruck production ramp. NVIDIA gains nearly 2% as H100 Tensor Core demand remains the structural bottleneck for deep learning. The lab breaks it down now. Tesla earns a 58 out of 100 hold. Cybertruck's 250,000 annual run rate target hinges on 4,680 cell yields hitting 95%, but Q1 filings show 82%. That gap kills gross margins. Wall Street ignores the fact that every 1% yield miss shaves $120 million off EBIT. The data teardown reveals Tesla's AI lead is real, but its hardware execution is slipping. Tesla's hardware mode is defined by the 640 mm superscript 2 die size, the physical surface area of the silicon chip of its custom D1 processor, delivering 2.5 times the on-chip bandwidth of a standard server GPU. While the market fixates on delivery numbers, the lab is tracking the transition to hardware 5.0, which utilizes a 3nm N3E process node, TSMC's latest manufacturing generation that increases transistor density by 60% over the previous 5nm process. This move eliminates the latency, the time delay in data processing, found in competitors like Lucid, who rely on off-the-shelf NVIDIA Orin modules. By designing the D1 specifically for video training, Tesla bypasses the overhead of general-purpose architectures. We see a massive delta in teraflops, or 1 trillion floating point operations per second, for what compared to the industry average. The physical constraint here isn't manufacturing cars, it's the TDP, thermal design power. The maximum heat a chip is designed to dissipate, which Tesla has optimized to 400 W for its AI clusters. This efficiency allows for higher rack density in their data centers, lowering the cost per training mile. Wall Street ignores the CoWES, chip-on-wafer-on-substrate, a high-density packaging technology that stacks chips to save space. Yields at TSMC that are currently favoring Tesla's simplified architecture over more complex multi-die designs. With a beta of 1.79, a measure of a stock's volatility relative to the market, the stock's 3.28% jump to $411.79 is a direct reaction to this compute advantage becoming visible. The engineering reality is that Tesla is a vertically integrated silicon powerhouse, and this structural lead in AI inference hardware is what pushed the market cap to $1.5t today. Quarterly financials showing modest revenue momentum for Tesla. Tesla is currently a high beta volatility instrument defying a 3.64% interest rate environment through aggressive AI scaling that has pushed revenue growth to 15.8%. While the Federal Reserve keeps rates steady, the yield curve, the spread between long-term and short-term interest rates, is finally normalizing at a positive 0.72%. This normalization typically signals a transition out of recession fears, yet prediction markets only price an 18% chance of a rate cut by late 2027. For Tesla, this means the cost of capital remains a structural friction, yet the company is maintaining an 8.3% EPS growth. Earnings per share, or the portion of profit allocated to each outstanding stock. The lab sees the current CPI, Consumer Price Index, which measures the average change in prices paid by consumers, at a negligible 0.6%, suggesting that while inflation is dead, the 3.64% Fed rate is a deliberate anchor on capital-intensive expansion. The macro narrative is shifting from monetary policy to raw protectionism as trade war fears over Greenland and new tariff uncertainties create a global bottleneck. With a beta of 1.79, a measure of a stock's volatility compared to the overall market, Tesla is hypersensitive to these geopolitical tremors. While the broader market stumbles under the weight of trade uncertainty, Tesla's AI score of 58 indicates it is decoupling from traditional automotive cycles. The lab identifies the primary risk as the escalating trade conflict, which threatens the supply chain of critical components. Management is pivoting toward AI-led resilience, yet the 2.1% short float, The percentage of total shares currently sold short by investors shows that skepticism remains regarding trade-related margin compression. Despite the global slide, Tesla reported earnings per share of $0.41, beating the Wall Street estimate of $0.38 by 8.7%. A solid beat that signals strong execution. Tesla is trending higher, currently at $411.79. Segment 3. The PR Insider Filter. Tesla Incorporated. Tesla's official script is all about AI demand and China tailwinds. Management wants you to believe the $410 breakout is just the start of a new growth curve. But the Insider Ledger tells a different story. Over the past 90 days, executives net sold 80,214 shares. That's not a liquidity move, that's a pattern. When insiders dump this aggressively, it's usually because they see margin compression coming before Wall Street does. And with institutions trimming their top 5 holdings, the smart money is voting with its feet. The EPS beat, 41 cents versus 38 cents. Looks like a win, but dig deeper. R&D spend surged 41.2% YOY to $6.4 billion, now 6.8% of revenue. That's not efficiency, that's desperation. Tesla is burning cash faster than its growing sales, signaling a pipeline that's either late or overpromised. And when management pivots from talking about volume to talking about shareholder returns, what they're really saying is, we don't have a new product story, so here's a buyback instead. The lab hears what Tesla isn't saying. The China narrative is a distraction. What's missing is any mention of yield on next-gen battery tech or Cybertruck gross margins. Instead, we get vague AI promises while R&D balloons. That's not innovation, that's a hedge. And when a 10Q finally drops, expect a risk factors section packed with warnings about commodity price volatility and regulatory delays. The same risks management glossed over in the earnings call. What Tesla is saying, AI demand is limitless. The momentum breakdown for Tesla, RSI sits at 56, pointing to bullish momentum, with buyers in control. MACD is currently bullish, with the histogram crossing above zero. Tesla's bull case rests on its massive data moat and the Cybertruck production ramp. The cup-and-handle pattern, a technical formation signaling a brief consolidation before a breakout, suggests institutional accumulation. With a bullish MACD, moving average convergence divergence, a momentum indicator showing the relationship between two price averages, and heavy call volume at the $420 strike, the market is pricing in a successful hardware scale-up. But here is what breaks the bull thesis. A trailing PE of 381.3x. The ratio of share price to per share earnings requires flawless execution that the current macro environment won't allow. U.S. tariffs on Chinese battery components are actively inflating the bill of materials, creating a physical floor on how low production costs can go. If these trade barriers persist, the forward PE of 162.4x is a trap, not a discount. The question that makes the room go quiet is, can the Cybertruck launch actually offset the margin erosion caused by rising import costs in a slowing global economy? The lab's answer is no. While the technical setup shows support at $348.95, the AI score of 58 reflects a neutralized risk-to-reward ratio. Management is pivoting to autonomy narratives because the automotive gross margin, the percentage of revenue remaining after direct manufacturing costs, is under siege by geopolitical policy. The lab's verdict is a hold. With an AI score of 58, we are not buyers at the $411.79 resistance level. Do not chase this momentum until you see a clean break above $416 or a retracement to the $382.79 moving average. Tesla is currently an engineering marvel facing a fundamental valuation wall. NVIDIA earns a 75 to 100 strong buy. The H100's 80 GB HBM3E memory stack delivers 3.35 terabytes per second bandwidth, crushing a 100's 2 terabytes per second. That's not marketing fluff, it's the margin driver. H100 ASPs sit at $30,000 plus, with gross margins north of 75%. Wall Street fixates on AI hype. We track the die shrink to TSMC. NVIDIA's dominance is cemented by the 10 terabytes per second, a measure of data transfer speed, interconnect in the Blackwell B200, which effectively doubles the reticle limit, the maximum physical area a lithography scanner can etch onto a silicon wafer. While Wall Street tracks revenue, we track CoESL, chip-on-wafer on substrate with local silicon interconnect, a packaging method using a silicon bridge to link multiple dies. The B200 uses 2 high-performance dies on a 4-MP process node, a specialized 4-nanometer manufacturing process from TSMC. This creates a massive 208 billion transistor powerhouse. AMD's MI300X uses a chiplet design with 153 billion transistors, but it relies on Infinity Fabric, which has higher latency, the time delay before a data transfer begins following an instruction. AMD is fighting a battle of yield, the percentage of functional chips produced on a single wafer, by using smaller chiplets. However, NVIDIA's Blackwell architecture hits 8 terabytes per second of HBM3E bandwidth. High bandwidth memory, a 3D stacked memory interface used for high-performance computing. This is a 33% jump over the H100. AMD's MI300X offers 5.3 terabytes per second, which is impressive but creates a bottleneck during large language model training. Today's quarterly financials showing modest revenue momentum for NVIDIA. NVIDIA is outrunning macro friction with a 95.6% EPS. Earnings per share, the portion of profit allocated to each outstanding stock unit. Engine that makes current 3.64% interest rates irrelevant to its capital structure. While the yield curve, the spread between short and long-term interest rates, is finally normalizing at a positive 0.72%. The lab sees this as a green light for the massive data center capex. Capital expenditures used to acquire or upgrade physical assets. That fuels NVIDIA's 73. NVIDIA reported earnings per share of $1.62, beating the Wall Street estimate of $1.56 by 3.6%. A solid beat that signals strong execution. NVIDIA is trending higher, currently at $211.50. Segment 3. The PR Insider Filter. NVIDIA Corporation. NVIDIA's official narrative is a masterclass in controlled optimism. Every press release, earnings call, and investor deck drips with AI demand is insatiable, and our supply chain is unbreakable. But let's cut the PR fluff. Insiders net sold 911,732 shares in the last 90 days. That's not a trickle, that's a liquidity exodus. When executives who build the hardware start dumping stock at this scale, it's not about diversification. It's a signal that the easiest growth is behind them. Historically, this pattern precedes margin compression or a node transition stumble. The lab doesn't do euphemisms. They're selling because they see the ceiling. EPS beat by plus 3.6% last quarter, $1.62 versus $1.56. So Wall Street cheers. But dig deeper. R&D spend exploded 43.2% YOY to $18.5 billion, now 8.6% of revenue. That's not efficiency. That's a desperate sprint to outrun Blackwell's yield curve and AMD's MI400 ramp. Management calls it investing in the future, but the lab hears, we're burning cash to stay ahead, and the ROI isn't guaranteed. The 8K language is even more telling. Suddenly, NVIDIA's SEC filings are packed with hedge disclaimers about regardless of any general incorporation language. Translation: we're bracing for legal or regulatory blowback. What's missing? Any mention of CoWES yield risks or HBM3E supply constraints. The momentum breakdown for NVIDIA. RSI sits at 58, pointing to bullish momentum with buyers in control. MACD is currently bearish, with downward histogram pressure. The bull case rests on the H100 Tensor Core GPU, a specialized processor designed to accelerate deep learning tasks. NVIDIA dominates through its shift to EUV, a precision light-based manufacturing process used to etch the smallest circuits. This hardware moat is widening as AI demand scales. At a forward P/E E of 18.7x. The ratio of stock price to projected earnings. The growth is priced in. But here is what breaks the bull thesis: geopolitical friction. U.S. export controls, government-mandated restrictions on shipping high-end technology, specifically target the A100 and H100 chips. If Chinese hyperscalers, massive cloud service providers, cannot buy NVIDIA overtakes Tesla, we're long-term bullish. Not financial advice. Do your own research.